the run up leading to the attack on Iran. So we had a run up in gold, as you can see, towards the mid February towards the end of February. And I even think President Trump put out a message or something that he was considering, launching an attack or whatever. And, to even say that you're considering an attack, I mean, that's got to be a clue, for markets like, okay, maybe something's going to happen. But the run up we had there. So do you just consider that noise, and does that detract from the gold bull market that we're currently in? How do you process the that move and then the recent pressure that gold is under?
Now, to do that, let me try to compress this chart quite a bit. I want to look at it. When you look at gold over time, let's go even back further. I'm going back to 25. I want to go back to, say, 24. Okay. So 24 in 2024, I want to make sure my cursor shows up. You had gold at about 2,300. There's been very few deep corrections all the way up. This is absolutely a bull market. What I have on the bottom is just stochastics. It tells you on a short-term basis whether it's overbought or oversold. Right now, we're going into oversold territory. You want to see across this green line, which represents a 20% mark. 80% mark is where we look for a market that's been moving higher to be overbought, here oversold. So I believe we are still absolutely A, in a bull market. B, we haven't really had any technical damage when you look at it. Technical damage would have to take it much lower, considering how fast and how much gold has moved up. There, to me, is absolutely no sign of real technical chart damage, which would convey a major pivot from bullish to bearish. I'm not seeing it. What I am seeing is corrections in the market, which are so needed because the market gets overheated when it hits these new highs, when it goes to certain price points, that without that correction, the longer it sustains that level, the more likely that the correction is going to be deeper and brutal. As we saw when it hit the all-time record high and then came down, over $1,000 in a period of 3 trading days. That's pretty brutal. And when you look at this chart, you can see that it's steadily moved up. You have these small corrections here, one here, but they're not really sizable. The first real sizable correction occurred in October 2025 when gold moved from 4,400 down to 3,900 or 4,000. So a $400 move down. But that's nothing like $5,600 down to just above $4,400. That's the kind of move we've never seen. And there's a reason for that. Gold has never been priced at this level. When you think about it, at the beginning of the year, we were just above 4,000. At the beginning of the end of 2024 to the beginning of 25, gold was at 2,800. And if we go to the beginning of 2024, gold was at 2,300. So we've had these enormously long and sustained upside moves. You cannot, in my opinion, look at this chart and say it's anything but fully in a bullish market sentiment scenario. You can't. It does hit peaks. It does correct. But then it's taken out every single high price here and here, except for the recent one that occurred at the end of January, the 5,600 one. Now, does that mean it won't take it out? I believe at some point it will. If it doesn't, it means that the underlying fundamentals, because I consider myself a hybrid trader, meaning I look at the technicals, but I'm fully under the knowledge and assumption that fundamentals move the market. because that creates market sentiment, and it's market sentiment that moves the market. And unless we have a massive shift in the fundamentals that have taken gold substantially higher in a multi-year bull run, it to me is still in a bullish mode.
Okay. Got it. So the big banks have their price targets on gold for this year, next year. I mean, some of them are forecasting 6,300, others, 6,000 and such. I'm curious in your price range forecast for gold for, the foreseeable future.
Yeah, I'm on record, and I believe I had this prediction. I know it was at the end of last year. Is that by the end, at some point, at latest by the end of this calendar year, we'll see $6,000 gold. Will that price point be sustainable? Well, it depends on how early in the year it hits that, because when you get these new all-time record high prices, you typically get a move down of profit taking. But $6,000 is where I see gold touching at some point during this year.
Okay. Got it. And do you factor in the 200 moving day average, 200-day moving average? So I was looking at that the other day, and gold is still significantly higher than that moving average. And so, I was kind of wondering if we could end up touching that again at some point.
I'm going to put the shortest term in blue. These are all simple moving averages. And the one I consider to be of absolute importance, the ones that I tend to follow are a little bit more short term than that. I look at the short term 20-day moving average, and then I look at the 50-day moving average. So that's why this price point right around 49.65 is so critical. The 50-day moving average, for since I've been a technician, is considered the benchmark for whether or not a market, gold in this case, is bullish or bearish. If it trades above the 50-day, it's considered bullish, below bearish. The other thing is that the reason I like to look at two at the same time, the 20 and the 50, is I look for whether they narrow or whether they widen in terms of that. And when you consider that it was August 2025, they're almost touching each other, you're getting it crossed. Since then, they have been in what I call full bullish alignment, which means the shorter term moving average is above the longer term. Obviously, it's more sensitive. It takes a lot more to move a 50-day. The 200-day, to me, I mean, I can put it up, but I prefer to look at the 50-day as a benchmark for where it is. The 200-day, if it's below the 50-day, most technical analysts, such as myself, already consider that to be a potential pivot, in this case, from bullish to bearish. And so that's what I look at. You can see that
Really,
really.
really quick, Gary. So when you're looking at that 50-day moving average, are you for it to close or below it? Are you looking at the daily close, a weekly close, as far as when that pivot, when you position yourself based off that pivot?
I am looking at a daily chart that starts with a close below the 50-day moving average, and for the next 2 days for it to continue to move lower. We can see it move into that area and back up, or below it move back up. But what I'm looking for is on a daily basis, if it breaks below the 50-day moving average, do we get follow through selling for the next couple of days? How deep that goes? And then what you'll see, of course, is a huge narrowing of the price differential. Whenever you look at what I call a short and a longer term moving average, what we're looking for during periods, and realize moving averages by the nature of what they are what I call lagging indicators. They tell you where the boats spin, not necessarily where it's pointed towards. There's an old saying one of my mentors used to tell me is that typically all of these different technical indicators are really looking from the back of the ship at the wake they've produced, but only the captain knows when he's going to turn the ship, when he's going to turn that wheel. And that's the advanced indicator. What we're looking at are lagging indicators because we're going back in time and then we're averaging it out. So by the sheer nature of the formula of that, it is a lagging indicator. So what I look for on a bullish market is a widening between two different lengths of moving averages. You know, you could use a 7 and a 13 day. You could use a 20 and a 40. But if you have enough space between the two moving averages, you want to see, is it widening or is it narrowing? Here we saw a huge narrowing right in December. And then it got really, really wide. And that peaked when we had this huge move beginning of January from 46 to 56 in a short period of time. So that's what I look at.
Okay. And what's the mechanics behind like the 50-day moving average? Is that like just a psychological thing, or is that just a common thing that most traders look at? What's your thoughts on the 50-day moving average? Why is that important?
Why I can't give you I have my theories, but they're just theories. The 50-day moving average, for as long as I have been a trader and I started studying and working with commodities and charts in 83, so quite some time ago, 40 years plus, those averages were always considered to be kind of a benchmark average, because in my early days of trading, anything longer than like a 13-day or 21-day moving average was like watching paint dry. Not so much now, because I want to take a big look or a long look at the market to get an idea. I know that they're lagging, but it gives me an idea. I can look back and see where, first of all, it needs to, if it's above both moving averages, like the 20, that's exceptionally bullish. So you got that through the beginning of 26 up to this top. After it fell, you see how it falls below the 20-day, and you actually have a wick, meaning the intraday low, that goes below the 50-day, but that was unsustainable. We have seen it break below the 20. It's now below the 20, which is why on my daily report for my subscribers, I talked about the fact that on Friday we had a close below the 20. And so the question is it going to be a sustainable move? And is that move going to be protracted? Because that tells me that we're entering a possibility of a shift, a pivot from bullish to bearish. Until I get a sustained move below the 50-day, I am not going to consider a major pivot has taken place. And then I'm going to look at the fundamentals in the market. The bottom line is dollar strength has been a huge factor in taking gold lower, but fundamentally, nothing has really changed with gold's with the environment that's moved gold higher. There's still military conflict. There's still things that are going on, and I haven't seen a major change in gold, but I see major price swing changes, and that's a shift in sentiment, but also not manipulation, but traders taking advantage of, they're booking profits. You know, if you get in at 4,500, it goes to $5,000 and you're trading futures, that's a huge profit. And so they're going to bank those profits. We also see those occur more frequently at the end of quarters of a year. So because that's when they're reporting that to their investors. So that has something to do with it. But when you look at this chart overall, you can't say anything but seeing this as extremely bullish, even with these big dips, because they're short term, they happen quickly, like here, Like here, you get a pretty big move. Here, 4,400 down to about 4,000. So you get these big moves, but nothing like the move we saw in 3 days that started on the 29th of January. We're
Mhm.
still in fully bullish demeanor. Market sentiment is fully bullish, but we're at a critical point. And the critical point I'm talking about is a solid break below the 50-day moving average for a sustained period of time.